In today's Hurst Cycles Geek update, I'm going to be speaking about the CML or Composite Model Line. I've called this part 1 because there is a lot to be said about this tool, and I'm sure I will be recording many further videos about it. This is a Geek update, and so you should be aware that I'm going to be getting involved in the details of the CML and speaking about how it is constructed and how it is used. If you are more interested in the outcome, if you like, of a Hurst Cycles analysis, in other words, what the analysis is saying about financial markets today, then I would encourage you not to watch this video, which you might find a little boring, but rather to watch one of my regular market updates. So let's speak about the CML or Composite Model Line. To start with, I wanted to show you why it was that I created the Composite Model Line as a tool in Sentient Trader. And that story starts with the insight that a Hurst Cycles analysis gives us. And I thought I would tell that story or illustrate the story today by showing you something that happened to me this week. I was performing some backtests on hourly charts, and when you perform a backtest in Sentient Trader, you set the analysis period back in time, and I did that for the 30th of September. Here we go. I took the analysis all the way back to the 30th of September. When you take an analysis period back, of course, Sentient Trader hides all of the future data so that you can consider the analysis at the time that you have set the analysis period. I changed my mind and I decided to do something different, and so I reset the analysis period. And for a moment, the chart showed me the full extent of the data, and it still showed the analysis that had been performed with the analysis period ending on the 30th of September. And that is why this analysis, as you can see, has some diamonds at the foot of the chart over here. But over this period of time, everything from the 30th of September forward, it is only showing the circles and whiskers. In other words, it's showing the analysis that was performed on the 30th of September. Of course, the software was immediately updating the analysis and fairly soon replaced the circles and whiskers over here with the results of the completed analysis. But I quickly grabbed this screenshot because I think it provides a really interesting illustration of what it is that a Hurst Cycles analysis does for us, which is that it provides us with insight in terms of what to expect and what is going to happen next. Let me show you what I mean by that. Let me clear those pen marks. A Hurst Cycles analysis uses these nests of lows, which are created by the circles and whiskers at the foot of the chart, to show us on the chart when the next trough of a particular cycle is expected. And so you can see with this analysis on the 30th of September, well, we had, if we really focus on the details, we had a 20-day cycle trough nest of lows over here right at the beginning of October. And you can see there was a low, which it turned out probably was a trough of the 20-day cycle. But the bigger nest of lows is more obvious. It's this 20-week cycle nest of lows over here in the second or third week of October. This is last year, of course, 2022. And you can see that the nest of lows was centered around this kind of period over here. The actual trough did form just a few days before, at that point over there, which was quite clearly in that nest of lows. And so if you cast your mind back to the 30th of September, at that time on this hourly chart, we would have been looking at this analysis with the nest of lows in the second week of October, which gave us good forewarning of the fact that the 20-week cycle trough was likely to occur at about that time. The next shorter cycle is this 80-day cycle, and here you can see the nest of lows is a little staggered. What tends to happen is as you move further and further into the future, the calculation of the recent average wavelength causes these cycles to separate a little bit because each cycle has its own recent average wavelength or current wavelength, and so they tend to get a little more straggly as you move into the future. But the 80-day cycle trough is clearly forming a nest of lows at this time over here in December, and of course here is that 80-day cycle trough that occurred a little bit towards the end of that nest of lows. I find these charts fascinating because it shows the power of a Hurst Cycles analysis. So why am I showing you this chart when I'm meant to be speaking about the Composite Model Line? The reason is because for many years I, of course, worked with Hurst Cycles notation at the foot of the chart. These diamonds and these nests nests of lows. And for somebody who's experienced at looking at diamonds and nests of lows, you can picture in your mind what the market is expected to do. Or at least you can certainly form the expectation for when troughs are meant to form. And if you have a peak analysis, then you can also expect when those peaks might form in the market. But many years ago, I realized that there was a better way of showing the implications of the analysis. And that is really what the composite model line is at heart. It is a different way of visualizing the analysis you have on your chart. So let's take a look at the CML. Let's start with this monthly chart of the SPX, and here you can see we have a 9-year cycle trough back in 1996, another 9-year cycle trough in 2009, and yes, I know that it doesn't add up to 9 years, but I'm not going to discuss that in today's update, and we have another 9-year cycle trough over here in 2020. The important thing about this is that, yet again, we have the diamonds at the foot of our chart, and for somebody who's experienced in this, that's all fine and well. But what does it actually mean, and is there a better way of visualizing it? Yes, there is, and so this is how the composite model line is constructed. The first thing that we do is that we extract the information from the cycle analysis, and that's a really important thing. If you would like to create your own composite model line, the first thing you really need is a Hurst Cycles analysis. Let me change the display of this chart to logarithmic, which makes a little more sense when you're looking at a long-term chart. And let me display what is called the cycle line for the longest cycle on this chart, which is the 9-year cycle. So the cycle line is simply a sine wave. The formula that is used to generate this line is a simple sine wave formula. But it is different to the sine waves that you might see in other software because this sine wave is informed by the analysis on the chart. That's a really important point to make here. There are other software applications that will extract cycle information from the price data, and they will construct a sine curve at the bottom of the chart, and those sine curves are often very regular because what they've done is they've extracted the formula for the sine curve from the full range of data. They've applied that formula and then they've placed it on the chart. The difference with what Sentient Trader does is a subtle but very important one. It has actually synchronized the troughs of the sine curves with the troughs of the cycles that have been found in the analysis. It's not a very complicated thing to do, and I'm sure if you have some mathematical ability, then you can work out how to do that. Each one of these waves in the sine curve actually has a slightly different wavelength, as has been calculated by the wavelength extracted from the analysis on the chart. The second aspect involved in plotting this sine curve is, of course, the amplitude, which is the amount of price movement that is created by this cycle from the trough all the way to the peak. The amplitude is extracted in Sentient Trader using a fairly simple approach, which was explained in detail by a British writer called Brian Millard, who was inspired by Hurst's work and wrote a few books about how the cycle information can be extracted from the data. You plot a displaced moving average and you work out what Brian Millard called the moving average difference, which was simply the difference between the price and the moving average, and you assume that that difference has been contributed by cycle action. You repeat that process for each and every one of the cycles in your analysis, and you have the amplitude for each one of those cycles. So now that we have extracted the information about the cycle, and here we're only looking at the 9-year cycle, we now have the wavelength for each one of the waves of the 9-year cycle, and we have the amplitude for each one of those waves as well. You can see that the 9-year cycle, according to this analysis, has actually been maintaining a very constant amplitude. When we look at the shorter cycles in a moment, you will see that the amplitude varies from one cycle to the next in those shorter cycles. So now we have the information about the cycle. That is what we call a cycle line in Sentient Trader. It's not a composite model line. A composite model line is simply a composing of multiple cycle lines. So let's do that. Let's now display the composite model line that includes only the 9-year cycle. And there is the composite model line that is composed of only the 9-year cycle. you can see that we have the same sine wave. In fact, the sine wave looks a little distorted, and that's because it is plotted on a logarithmic chart. I can change that back to a linear chart, and we end up with waves that look a little more correct in terms of them being sine waves. But let's stick with the logarithmic chart for now. And so you can see our composite model line that consists of only one cycle is not really very impressive. It doesn't tell us very much about what was happening in the cycles over this period of time. But of course, what it does tell us is that from this time over here in 1996, the 9-year cycle would have caused prices to rise. And then, of course, it would have caused prices to fall again into the 9-year cycle trough over here in 2009. But in terms of modeling the price action, it's not doing very well. What, for instance, happened over here? Price came down and then price rose up again. Well, a composite model line that consists of only one cycle is not going to be very impressive. We know as Hurst Cycle analysts that what was happening at around about this time in 2002 was that price was coming down and forming a 54-month cycle trough. Again, I'm not going to worry too much about the details of this analysis. We're not going to debate the magnitude of these troughs for the sake of today's example. So let's assume that was a 54-month cycle trough that formed in 2002. Let's add the 54-month cycle to our cycle lines. Now you can see the 54-month cycle, which of course caused price to drop into the trough in 2002 and then to rise up again. Notice that the 54-month cycle has been calculated to have had a lower amplitude during this wave from 1996 to 2002, and then a higher amplitude from this wave from 2002 to 2009. The reason for that is because, as I've explained, the amplitude is calculated for each one of the waves. And so these cycle lines do look different to the sine curves that you will see at the foot of other software applications, are calculated to accommodate for the actual wavelength that that cycle experienced and also the actual amplitude. Notice, interestingly, that we have a very high amplitude 54-month cycle that we are currently looking at the moment. Now let's add our 54-month cycle to the composite model line. And again, our composite model line doesn't really look very much like that price action. But let's zoom in on the price action and consider in a little more detail this 9-year cycle that elapsed from 2002 to 2009. Now you will notice that the composite model line involving only these two cycles is actually showing a fairly good match to the price action that occurred over this period of time. Of course, we're looking at a monthly chart, and so it's a very rough approximation of this price action. But one of the things that you will notice immediately is that the composite model line doesn't really come all the way down into the price trough that occurred over here. And also, the peak that occurred over here in the composite model line occurred much later in the price action. Now, you probably know what that means when a peak occurs late in the price action. It means that there is a bullish underlying trend. In other words, longer cycles than the cycles that we can see in this analysis caused this peak to occur later than it would have if the cycles that we see at the foot of our chart, or that have been included in the composite model line, were the only things influencing this price action. And so how do we account for those longer cycles? Hurst defined something called sigma L, which is simply the sum of all cycles longer than the longest cycle found in the analysis. And sigma L is also calculated by Sentient Trader. The calculation of sigma L is a little complicated, and I'm not going to explain it in great detail in this video. Suffice to say for now that what Sentient Trader does is it builds a composite model line out of all the cycles that it has in the analysis, and then it looks for signs of much longer cycle action, including, in particular, things like displaced peaks to the right, which indicate that there is a bullish sigma L over this period of time. We can include sigma L in our composite model line, so let's do that. Now that we've included sigma L over this period of time, you will notice two important things have happened. First of all, this big drop into the trough over here has been accounted for by sigma L, in other words, the longer cycles. The other thing that has happened is that the composite model line's peak has been shifted further to the right. It still doesn't quite match up with the peak in price, but the sum of all longer cycles has influenced the composite model line to match price action a little bit better. And so that is how the composite model line is constructed. Let's add the next shorter cycle, the 18-month cycle. When we add the 18-month cycle to the composite model line, you can see interesting things such as this little move up over here, which is accounted for by the fact that an 18-month cycle trough has been found over there. And you will also notice some more detail in the downward move over here caused by that 18-month cycle. But now I've zoomed in on this period of time from 1996 to 2002 simply to demonstrate the way in which the different cycles can be combined. You should know that when Sentient Trader is performing an analysis, it doesn't focus too much on the details of what happened 20 years ago, because that is not really very important for what is happening now. That's a bigger discussion that we can perhaps have at a later time. But let's zoom forward and take a look at what is happening now using just these 3 cycles in the composite model line that I have combined. So here is the result of combining the 9-year, 54-month and 18-month cycles over recent time. Again, you must remember that in the past, the composite model line is referring to the analysis on your chart. And so it is not a huge surprise that the composite model line matches the analysis on the chart. That's a really important point to note, because the composite model line is effectively, when looking at it over past price action, little more than a mathematical conjuring trick. What I mean by that is that we've taken data, we have extracted cycle information, we have then recombined that data and put it back on the chart. It's not a huge surprise that it looks very similar to the price action. The only thing that we have done, and this is an important detail, is that we have filtered it through the principles that apply to a Hurst Cycles analysis. In other words, enforcing synchronized troughs and particular harmonic ratios between the cycles. If we hadn't done that and we had simply extracted the information and then recombined it, we would see a perfect match of price action. And that would be no more than a mathematical conjuring trick. A bit like me saying to you, think of a number and then subtract this and multiply by this and divide by that, and hey presto, you end up with the same number. And so by applying the filter of Hurst Cycles principles with these synchronized troughs, the composite model line is a little elevated above a mathematical conjuring trick, because it does show us how accurately the cycle analysis reflects what actually happened in price action. Of particular interest is this trough over here in March of 2020, which I often refer to as the pandemic trough. You can see that according to the pure cycle action, we were not expecting price to come nearly so far down, even when combining all of these cycles, 9-year, 54-month and 18 months. And so taking a look at the composite model line over past time does give you a fairly good way of assessing the cycle analysis that you have on your chart. In fact, before the composite model line was available, we used to look at our charts and we used to simply say, here's an important trough in the analysis. Is that an important trough in the price action? And if it is, that's an indication of a good analysis. However, the composite model line gives us a more accurate way of doing that. We can look at the composite model line and ask ourselves, how well does the composite model line reflect price action? The better it reflects price action in the past, the more accurate the analysis is, and therefore our confidence that the analysis is in fact a correct analysis increases. Now, what about the composite model line in the future? How is the composite model line generated in the future? Well, again, let's refer to our cycle lines. Here are our cycle lines, which, as I've mentioned, draw information from the cycle analysis in order to calculate the cycle wavelength and the amplitude. What happens as we move into the future? What Sentient Trader does is that it assumes that each one of these cycles will return over time to the average wavelength in your nominal model. In other words, your nominal model's wavelength for that cycle. So you will notice that this next cycle wave for the 54-month cycle actually encounters a trough over here, whereas the circle for the next expected trough of the 54-month cycle is displaced fairly far to the right. That's because Sentient Trader assumes that the 54-month cycle, clearly calculated to have been running long in this analysis, will return over time to the average wavelength of the 54-month cycle, which is of course about 54 months. And the results of combining these cycle lines in the future also give us a composite model line that extends into the future. You should be aware, however, that the further we look into the future with either a cycle analysis or with the composite model line or with these cycle lines, the less reliable that becomes. Because of the principle of variation, we know that every one of these cycles is going to experience a different wavelength as it moves forward in time, and the amplitude of each one of these cycles is going to change. And so sometimes, as I demonstrated at the beginning of this video with that chart of the hourly analysis performed at the end of September, sometimes we get a really good, clear idea of what is going to happen over many months lying ahead. Sometimes, however, it is not going to be a good and clear analysis. But now I would like to finish off today's video by focusing on a really important way in which the composite model line can be used to resolve analysis anomalies. At the moment, you will know that recently we have been considering the magnitude of this trough that happened in December of 2022 as being of either 20-week magnitude or perhaps 18-month magnitude. How can the composite model line be used to help us to resolve the situation with that analysis? Let's zoom in and take a look at a little more detail. And I've changed the scale to a weekly chart, and let's add some more cycles into our composite model line. First of all, if we take a look at past price action, you can see that over this period of time from early 2018 to present time, the composite model line has in fact modeled price action fairly well. This persistent bullish move that we experienced over here is not modeled very well because, of course, one of the limitations of the composite model line is that it does expect cycles to operate a little bit like sine curves with a move up and then a move down. And that can be seen in the composite model line. The reason why these moves down over here are so reduced is because of the influence of the longer cycles that are also pushing upwards. But what actually happened in price action, as you can see, was a fairly solid upwards move. So how can we start to resolve the current analysis anomaly, which has to do with the magnitude of this trough over here in October of last year? Well, let's take a look at the other analysis, which considers that this trough that formed in October was a trough of 18-month magnitude. And here is that analysis with the composite model line using the same cycles. The interesting thing is that this composite model line has a much greater discrepancy between price and the composite model line over this period of time over here, where it was, of course, expecting price to come down into the 18-month cycle trough in October of 2021, where we had a declining composite model line, whereas we had a rising price action. However, the composite model line in recent time has proved to be more accurate. Now, there might well be ways of resolving that by moving this 18-month cycle trough. For instance, some analysts believe it occurred in May or in June. Let's zoom in and finish off by taking a look at some of the finer details of what has been happening recently. I've switched back to the other chart, which of course expects the 18-month cycle trough to occur towards the end of February or perhaps in early March, and you can see that the composite model line, using only cycles down to the 20-week cycle, was of course expecting an M shape for this 40-week cycle, which you can see in the composite model line, was expecting a lower peak over here because of the fact that this should have been a bearish cycle, M-shape, coming into this 18-month cycle trough. You can see that the composite model line matches price action fairly well all the way up to this peak. Recent price action, in particular the bounce out of the 80-day cycle trough, has contradicted the composite model line, which is a warning that there is in fact something wrong with this analysis. Let's add a little more detail to this composite model line. I've added the 80-day and the 40-day cycles into the composite model line, and again you can see that it matches past price action fairly well. Even up to the 80-day cycle trough over here, price was expected to move down, as it pretty much did. Following that 80-day cycle trough, the composite model line would have had us expect price to rise up to an early peak and then of course decline into the big cycle trough expected over here towards the end of February. As you can see, that is not what has happened to price. We'll zoom in a moment and take a look. One other detail about the way in which the composite model line is plotted. You will notice that the composite model line shifts relative to price as we zoom in and zoom out again. That is important and it is necessary. What the composite model line does is it scales itself according to the maximum price visible on the chart and the minimum price visible on the chart, and it scales according to that scale. If the composite model line was rooted way back at the beginning of the analysis in 1995 or something like that, and accurately measured the price action using the amplitude and the wavelengths of the cycles from that date, then it would drift very far from price because of the variations between price and the composite model line. And so this rescaling of the composite model line is an important feature of it, but it is something to be aware of. It means that the actual price levels of the composite model line are not nearly as important as the structure of the line itself. What I mean by the structure is that when price is moving down, the composite model line is also moving down, and when the composite model line is moving up, price is moving up. You should avoid falling into the trap of measuring the price of the composite model line and saying that therefore that is the price at which we expect that trough to occur. That is not necessarily the case. Sometimes it does work fairly accurately because the composite model line has been scaled to recent price action. But the structure of the line is much more important than the actual price levels. Let's take a look at the other analysis at about the same zoom scale. Here is that other analysis with the 18-month cycle trough in October of last year. You will notice that during this period of time over here on the move down into that 18-month cycle trough, the composite model line really does not match the price action very well at all. In fact, it is fairly contradictory at various times. Part of that could be because this analysis is not honestly very good when we take a look at it. We could spend a little time trying to refine it, but we're not going to do that for now. The interesting thing about what has happened since then is that the composite model line does match price action a little bit better, with price rising out of this trough up to a peak expected about over there. However, the drop into the 80-day cycle trough is not really reflected in the composite model line, but the rise out of the 80-day cycle trough is certainly reflected by the composite model line. However, it was not expected to be such a strongly accelerating move upwards. Here is the move down to the 20-week cycle trough expected now in the middle of February, as can be seen in that analysis. Let's zoom in one more time and draw some conclusions. Starting with this analysis with the 18-month cycle trough over here in October, you will notice that there has been some divergence from the composite model line recently, in fact ever since the drop down into the 80-day cycle trough. Although the structure of the composite model line indicated a drop down, price dropped a lot further than it should have. What does that mean? It means that the drop down into the 80-day cycle trough was of a magnitude not really contained in the cycle information. That's quite important. Since then, we've had this constant and fairly accelerating upwards move, which is also not reflected in the composite model line. Although we did expect an upwards move, we should have experienced a peak about over here. Of course we did, and we had a small move down, but this recent accelerating upwards move is not supported by the cycle information. When you see that kind of thing happening, it is time to sit up and take notice. It is possible that this market is being distorted to the upside. I'm sure I don't need to list all the things that are happening in the news at the moment, but it is certainly possible that those events are causing some distortion to this analysis. Nevertheless, we are expecting price to drop into a 20-week cycle trough over here sometime in February. And then according to this analysis, after that trough forms, we should expect to see price rising to a higher peak. On the other hand, we have this analysis, which of course has the 20-week cycle trough in October, and it has the 18-month cycle trough still lying ahead. Despite the recent strongly bullish action, I continue to watch this analysis because of the fact that the composite model line matched so much better all the way up to this point over here. Can you see that? The composite model line is really a pretty good match for price action. Only over here in the past 2 weeks have we seen price deviate so markedly from the composite model line. In my opinion, this might be a warning that there has been distortion in the markets and that we need to be aware of the possibility of price moving down hard into a trough expected towards the end of February. Either way, both of our analyses and the composite model lines warn us that price is going to move down into a trough of at least 20-week magnitude, possibly greater magnitude. This particular analysis provides us with a sterner warning to look out for the possibility that this recent price action is not actually sustainable and represents a distortion in terms of the cycles that are influencing the markets. I do hope that this Geek video has provided you with some insight into the composite model line, what it is and how to use it. I'm sure, as I mentioned at the beginning of this video, that I will be recording many more videos about the composite model line, which is a very powerful and useful tool in Sentient Trader. I also hope that the information I've provided in this video will enable you to create your own composite model lines if you're not working with Sentient Trader, and can start experiencing for yourself the power of a Hurst Cycles analysis.